For decades, Japan ran its entire banking industry on one simple military metaphor. A convoy only moves as fast as its slowest ship. Regulators didn't just tolerate weak banks, they actively protected them, using licensing power and informal guidance to make sure no bank in the fleet ever fell behind and sank. It was called the Convoy system, and for nearly 40 years it worked. Then, in a single 12-month stretch, a major city bank, one of the country's biggest securities firms, and a life insurer all collapsed anyway.
The idea came from a wartime image. Picture a convoy of merchant ships crossing dangerous waters together, surrounded by escort vessels, moving not at the speed of the fastest ship in the group, but at the speed of the slowest one, so that even the weakest, most vulnerable vessel makes it through safely. Post-war Japan's Ministry of Finance took that exact logic and applied it to the entire banking industry. The goal was never to reward the strongest banks for outrunning their rivals. The goal was to make sure the weakest banks never failed publicly at all, because a visible bank failure, in the ministry's view, was a threat to confidence in the whole financial system, not just to the one institution that failed. Using its licensing power, and using informal guidance that never had to pass through Parliament as a written law, the ministry effectively set the pace for the entire fleet of Japanese banks. No single institution was allowed to move so far ahead that it left its slower rivals exposed, and no institution was allowed to fall so far behind that it broke formation and went under in public view. Everyone in the convoy moved together. At least, that was the design.
In practice, this meant the ministry controlled almost every lever that could create winners and losers inside Japanese banking. Interest rates on deposits and loans were kept roughly uniform across the entire industry, which meant a bank could not simply outcompete its rivals by offering better terms to depositors or cheaper loans to borrowers. Price competition, the most basic tool banks anywhere else in the world use to grow, was effectively taken off the table. Opening a new branch required the ministry's approval. Entering certain lines of business required the ministry's approval too, and that approval process controlled how many players were allowed to fight over the same customers in the same territory, keeping any one bank from overwhelming its neighbors through sheer expansion. Long-term credit banks, foreign exchange specialist banks, and small business lenders each operated in their own designated lane, a division of labor coordinated from above by the ministry, rather than something banks had to fight for and win in the open market. And if a bank still found itself in serious trouble despite all of this coordination, the standard response was not bankruptcy. It was a ministry-brokered merger, arranged quietly, folding the struggling bank into a healthier one before the public ever had to see a bank fail. The system was not designed to produce winners. It was designed to make sure no one visibly lost.
Japanese financial commentary that has documented this system in detail describes the underlying logic in a single, precise way. Administrative agencies using their licensing authority to control an entire industry, so that even the operator with the least competitive strength could survive without ever falling out of formation. Here is that description in the original Japanese, exactly as written by analysts who have studied this system closely. That's not a side effect of the convoy system. According to this analysis, it was the entire point. Every uniform interest rate, every branch approval, every quiet merger you just heard about, all of it existed to serve that single sentence. This was the system operating exactly as designed, not maximizing efficiency, not rewarding the strongest competitors, but minimizing visible failure for decades across the entire industry without exception.
And for a long stretch, minimizing visible failure was arguably the right call. This convoy structure did not appear out of nowhere. It grew directly out of Japan's main bank system, in which large companies maintained deep, long-term financing relationships with a single primary lender, rather than shopping around for the cheapest capital on the open market, the way companies in other economies typically did. That primary lender knew the company intimately, sat close to its management, and in return provided patient, stable financing that didn't disappear the moment conditions turned uncertain.
The Convoy system essentially took that same logic of patient, coordinated long-term relationships and scaled it up to cover the entire banking industry itself. Historians of Japan's post-war economy generally credit this tightly regulated financial structure, dull, uniform, heavily managed, unglamorous by almost any modern definition, with helping fuel the country's extraordinary rate of growth through the mid-1970s. Stability, in this reading, wasn't just a side benefit bolted onto the system. In an economy trying to rebuild from wartime devastation and industrialize as fast as possible, predictable and protected capital was arguably a precondition for the growth that followed, not an obstacle to it. Companies could commit to long, expensive industrial projects precisely because they trusted their bank and their banking system would still be standing years later.
But the same system that worked so well inside a closed, controlled, domestic economy started breaking down the moment Japan's financial markets opened up to the rest of the world. From the 1980s through the mid-1990s, financial deregulation spread steadily across the industry, loosening exactly the kind of controls that had kept the convoy in formation for decades. Japanese banks increasingly found themselves competing in international capital markets that had never heard of and had no reason to respect convoy logic. Out there, nobody was going to slow down for the weakest ship. And back home, the whole incentive structure that had kept the quiet merger system working began to erode. For years, the Ministry of Finance could reward a healthy bank for absorbing a failing rival with regulatory favors worth having, an easier branch approval, a more favorable line of business, something worth trading a rescue for. But as deregulation opened up new paths to growth that didn't run through the ministry's approval process, those regulatory rewards started losing their value. Why take on a sinking rival's bad debts in exchange for a favor you no longer needed? The convoy was technically still moving. The ships were still nominally sailing in formation. It just wasn't nearly as protected as it used to be, and the cracks were already showing well before anyone outside the industry noticed.
In 1995, the quiet merger playbook that had held the convoy together for 40 years finally broke down in public. The Kizu Credit Cooperative collapsed. Hyogo Bank failed too. Together, they were marked as the first post-war bank failure in Japan's history, a label that mattered because it meant exactly what it sounds like. For the first time since the war, the ministry could not quietly arrange a rescue before the public found out a bank had gone under. It was the sound of one ship finally sinking in full view, after decades in which that sound had simply never been allowed to happen. Then came 1997, and the single failure of 1995 turned out to be a warning nobody fully heeded. In the space of a single year, Hokkaido Takashoku Bank, one of Japan's major city banks, the exact kind of institution the convoy system existed to protect, collapsed. Yamaichi Securities, one of the country's largest and most storied brokerage firms, went under. So did Sanyo Securities. And Nissan Life Insurance failed too, the first post-war failure of a Japanese life insurance company, a different sector of the financial system entirely, showing this wasn't contained to banking alone. 4 major financial institutions, spread across 3 different sectors of the financial industry, all collapsed within 12 months of each other. This wasn't one slow ship quietly falling behind schedule, the exact scenario the entire convoy system had been built to manage. This was the entire convoy losing formation at once, in full public view, after nearly 40 years in which that was supposed to be impossible.
The response in 1998 was to formally dismantle the very system that had just failed so visibly. Japan established the Financial Supervisory Agency, splitting bank inspection and supervision away from the Ministry of Finance entirely, an agency that for decades had been simultaneously the architect of the convoy system and the regulator responsible for policing it. Separating those two roles was itself an admission that the old arrangement had built in a conflict that let problems go unaddressed for too long. The shift was away from informal guidance, the quiet phone calls and unwritten understandings that had run the industry for 40 years, and toward rule-based regulation instead. Regulation written down, applied consistently, and enforced independently of personal relationships between regulators and bank executives. That included early corrective measures, tools specifically designed to catch a failing bank while it was still salvageable, rather than waiting until the only options left were a hidden merger or a public collapse. The Convoy model: protect the weakest, manage the pace of the whole fleet, avoid visible failure at almost any cost, was replaced by a system built on a very different premise. Let failure happen early and openly while there's still time to contain it, rather than hide it until the day it can no longer be hidden at all.
The Convoy system wasn't a failure of good intentions. For nearly 40 years, it did exactly what it was designed to do: keep weak institutions afloat and keep failure invisible to the public that depended on them. But a system engineered to prevent any single ship from sinking is not the same thing as a system built to survive open water once the storm actually arrives. When Japan's financial markets finally opened up to real international competition, the Convoy didn't adapt to the new conditions. It broke all at once: a Citibank, a securities firm, and a life insurer going under within the same 2-year stretch. The exact outcome 40 years of careful, quiet management had been built to prevent. Subscribe, and I'll see you in the next one.